let's talk about what just happened to silver, because this is not just another dip. Silver is trading around $64 per ounce, its lowest level in nearly 3 months. But the price itself isn't the real story. The real story is that silver has broken below its 200-day exponential moving average for the first time since April 2025. If you understand what that line represents, then you understand why investors all over the world are suddenly paying attention. This isn't simply volatility. This could be a regime change. The support level that carried silver from roughly $30 all the way to $121 held for more than a year. Today, it doesn't. So the question isn't whether silver went down. It did. The real question, whether this is another painful correction inside a long-term bull market, or the moment the bull market actually ended, because those are two very different situations, and confusing one for the other can cost you a lot of money. Let's start with the facts. Silver has fallen nearly 47% from its January 2026 peak near $121, wiping out months of gains in less than 5 months. That's not normal volatility. That's a collapse by almost any reasonable definition. Gold has been falling alongside it, slipping below $4,200 per ounce and reaching its own 3-month low. This tells us that something bigger is happening beneath the surface. The catalyst everyone is pointing to is the latest jobs report. The employment numbers came in much stronger than expected, showing that the economy remains resilient. Normally, strong economic data is viewed as positive, but in today's environment, strong data is bad news for precious metals because it gives the Federal Reserve less reason to cut interest rates. Higher interest rates increase the opportunity cost of holding non-yielding assets like silver. Silver doesn't pay income. Treasury bonds do. If investors can earn attractive yields elsewhere, capital naturally rotates away from metals. That's the mechanical explanation for why silver is under pressure. But here's what most people miss. The jobs report didn't create this sell-off. It simply accelerated a weakness that had already begun months earlier. Back in late January, the EMA raised margin requirements on silver futures. That decision forced leveraged traders to reduce positions. Selling triggered more selling, and within weeks silver collapsed from above $120 to below $60. Then, something interesting happened. The market stabilized. For nearly 3.5 months, silver traded within a broad range. Bulls defended support levels while bears sold into rallies. The market was essentially trying to decide what came next. At the center of that battle sat the 200-day EMA. As long as silver remained above it, the long-term bull market structure technically remained intact. The decline could still be classified as a painful correction, but this week changed everything. Silver broke below the consolidation range, fell through the 200-day EMA, and kept falling. The technical structure that supported this market for more than a year has now been damaged. That doesn't mean silver is going to zero. It doesn't mean everyone who bought silver made a mistake. It simply means that, for now, the path of least resistance points lower. Technical trends matter because they influence behavior. When support breaks, confidence weakens. When confidence weakens, sellers become more aggressive and buyers become more cautious. That's the environment we're entering today. If you're holding silver right now, there are several key levels you need to understand. The first major support sits near $61 per ounce. This level held earlier this year and could attract buyers again. If that support fails, the next important level is around $55, an area that previously acted as resistance before turning into support. Markets often revisit former breakout zones. If $55 doesn't hold, the next meaningful support doesn't emerge until roughly $46 per ounce. That would represent another significant decline from current levels, and in a true worst-case scenario, if fear accelerates and buyers remain absent, technical projections suggest silver could eventually revisit the $30 area. Is that the most likely outcome? No, but markets don't stop falling simply because prices feel cheap. They stop when demand finally overwhelms selling pressure. Technicals tell you what is happening. Macro conditions tell you why. The larger issue right now is the interest rate environment. Persistent inflation keeps the Federal Reserve cautious. Elevated energy prices continue, feeding inflationary pressures throughout the economy. If inflation remains stubbornly high, the Fed has little room to ease monetary policy. Higher rates support the dollar. A stronger dollar reduces international purchasing power for commodities priced in U.S. dollars rising. Yields attract investors toward income-producing assets. The result is a difficult environment for precious metals. Just a few months ago, investors expected multiple rate cuts. Today, many are debating whether another rate hike could still happen. That dramatic shift in expectations has changed market psychology. However, history teaches us something important. Silver has crashed before. In 1974, silver experienced a massive decline before, eventually delivering extraordinary gains in the years that followed. During the 2008 financial crisis, silver collapsed alongside nearly every major asset class before staging an incredible recovery. But in 2011, silver entered a long and painful bear market that lasted years. The difference wasn't the size of the decline. The difference was whether the underlying fundamentals remained intact. A crash becomes an opportunity when the original investment thesis survives. A crash becomes a disaster when the reasons for owning the asset disappear. So, what about today? Have the structural foundations supporting silver actually broken? Surprisingly, many of them haven't. Global supply challenges continue. Mine production cannot increase overnight because developing new production takes years. Industrial demand remains strong. Silver continues to play an essential role in solar technology, electric vehicles, advanced electronics, and emerging AI infrastructure. Those trends haven't disappeared because prices fell. The world still needs silver. Long-term demand drivers still exist. This creates an unusual situation where technical conditions and structural fundamentals are moving in opposite directions. The technical picture has deteriorated significantly. Momentum favors caution, yet the long-term fundamental story hasn't completely broken apart. That means silver investors are caught between two competing forces. On one side stands the macro headwind of higher rates, stronger yields, and cautious central banks. On the other side stands the structural story of supply, constraints, and growing industrial demand. The next phase for silver will likely depend on which force ultimately wins. If inflation eases and policymakers gain flexibility, investor appetite for hard assets could return quickly. If rates remain elevated and economic uncertainty persists, further downside cannot be ruled out. That's why emotional decisions are dangerous. The investors who succeed during periods like this aren't necessarily the smartest. They're the ones who remain disciplined. They know their risk levels. They understand their time horizon. And they have a plan before volatility arrives. Here's the truth. Nobody knows exactly where silver will trade next month. Nobody knows whether $64 will ultimately be remembered as a historic buying opportunity or merely another stop on the way lower. But uncertainty doesn't mean helplessness. It means preparation. If you're invested in silver, decide in advance how you'll react if prices revisit $61, $55, or even $46. If you're considering entering the market, understand that lower prices are always possible. Even when long-term fundamentals remain attractive, markets move in cycles. Fear eventually gives way to optimism, and optimism eventually gives way to fear. Today's environment is dominated by caution. The trend is bearish. The technical damage is real, but long-term investors should remember that some of the greatest opportunities in history emerged during moments when confidence disappeared completely. The framework is simple. The technical trend is currently negative. The macro environment remains hostile. The structural fundamentals still appear intact. Until those macro conditions improve, respect the trend and manage risk carefully. But if and when conditions eventually shift, silver could once again remind the world why it has been one of history's most volatile and rewarding assets. Before we wrap up, I'd love to hear your thoughts. Where are you watching from? What city or country are you in? And what time is it there right now? Do you think silver is presenting a generational opportunity? Or do you believe this downturn has further to go? Let me know in the comments below. If you found this analysis valuable, consider supporting the channel and sharing it with someone who follows the precious metals market. Stay informed, stay disciplined, stay honest with yourself about what you own and why you own it, and I'll see you in the next video.